Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to Fairport Flash. My name is Rick D'Amico, Manager of Investments at Fairport. I'm primarily responsible for managing the firm's fixed income and alternative investment strategies. Today I'd like to focus on fixed income and some of the factors that have influenced interest rates as well as fixed income returns and how this impacts our outlook going forward. So let's get started. First, let's discuss the Federal Reserve and the influence Chairman Powell has had not only on the equity markets, but the fixed income markets over the past 6 months. If you can recall, back in October of 2018, Chairman Powell made the statement that the Fed was, quote, a long way from neutral regarding its benchmark policy rate. The neutral rate is the policy rate that is viewed as being neither restrictive nor accommodative to the economy. At the time, the Fed funds target range was between 2% and 2.25%, and the market did not take well to the chairman's comments regarding the neutral rate. The fear was that the Federal Reserve had fallen out of line with the market's expectations, increasing the risk that the Fed would tighten too far, too fast, pushing the economy closer to a recession. Fast forward to today, and the Fed has adopted, in their terms, a much more patient approach. After the Fed's December rate hike, the Fed funds rate at 2.5% now stands just 25 basis points below the FOMC's long-run projection of 2.75%. And while the FOMC's median dot projections forecast 2 interest rate hikes in 2019, the Fed funds futures market is not pricing in any additional rate increases this year. So what does the Fed's wait-and-see approach mean for rates and fixed income returns going forward? There is precedence for this. Since 1962, there have been 6 cases in which the Federal Reserve has paused in the midst of a tightening cycle. According to Ned Davis Research, 10-year Treasury yields increased on all 6 occasions by a median 28 basis points, which from today's levels would put us at 2.9% on the 10-year yield if and when the Fed resumes its tightening cycle. Credit also outperformed during Fed pauses. In 5 of the 6 cases, investment-grade credit spreads narrowed by a median 23 basis points. As a refresher, credit spreads can be thought of as the additional yield required by investors over and above the comparable U.S. Treasury to compensate investors for a likelihood of default. In fixed income investing, credit spreads are often used as a valuation metric when gauging the attractiveness of different sectors such as high yield, investment grade, or emerging market debt. In times of market stress, such as we saw towards the end of last year, credit spreads can widen considerably. For example, high-yield bond spreads widened from 316 to 544 basis points over treasuries. At that time, there were a number of factors weighing on credit. These included uncertainty around monetary policy, heightened trade tensions between the United States and China, a government shutdown, falling growth expectations, and other geopolitical risks such as Brexit and the riots in France. These issues increased the potential of a slowdown or even the risk of a recession and led to a 20% correction in the equity markets as well as a pullback in interest rates. While some of these risks still remain, others have dissipated, and importantly, the market now has clarity on Federal Reserve policy. The equity markets have had a strong start to the year, and along with equities, credit, more specifically high-yield bonds, have rebounded sharply. Credit spreads within most sectors of the fixed income markets are now back well below their historical mean, and from a valuation perspective, you could make the argument that credit now looks slightly rich. Let's move our attention to the general level of interest rates. 10-year Treasury yields at 2.61% are trading at the lower end of their current range and right on top of an important support level, testing the flight to safety lows we saw in late December. If the 2.60% support level holds, in our view, we are likely to see rates range bound between 2.6% and 2.9%. A decisive break below 2.60 on the 10-year targets 2.4%. So exactly what are some of the influences pulling rates down towards the low end of their range? Fed policy, inflation, and German bond yields are 3 factors that tend to be highly correlated with bond yields. We've already touched on Fed policy and how the Fed is likely to remain on hold for this year. Inflation at 1.9%, as measured by the core PCE or Personal Consumption Expenditures Index, appears to be stabilizing below the Fed's 2% target and looks to be trending even lower. These low levels of inflation support the Fed's policy pause discussed earlier. And 10-year German bond yields at 0.052% are trading at their lowest level in over a year. These 3 factors we discussed, 1, the Fed being on hold, 2, a benign inflation outlook, and 3, low global bond yields, are some of the influences responsible for anchoring rates at these lower levels. Now, when discussing our outlook for fixed income, the level of rates is very important because historically there has been a very strong correlation between the starting level in bond yields and subsequent 5-year returns. According to analysis done by JP Morgan, when the starting level in yields is where we stand today, call it 3.21% on the Bloomberg Barclays U.S. Aggregate Bond Index, the implied subsequent annualized 5-year returns are rather modest at 4.01%. So in summary, we have muted return expectations for fixed income going forward, and this is based not only on the low level in starting yields, but also firm valuations, as most sectors within fixed income are trading below their historical mean. In addition, the Fed is on hold and the market is not expecting any additional rate hikes in 2019. Historically, when the Fed has paused during a tightening cycle, interest rates have tended to gravitate higher, while spreads have continued to tighten, albeit modestly. This falls in line with our current positioning at Fairport, as we are short duration relative to the Bloomberg Barclays U.S. Aggregate Bond benchmark. This stands to benefit investors should rates trend modestly higher, as they have historically when the Fed takes a pause. We are also overweight credit, which could benefit portfolios if spreads were to grind tighter. This brings us to the close of today's Fairport Flash. As a reminder, our goal at Fairport is inspiring families, and as a member of the investment team, we strive to do this through a long-term, diversified approach. If you would like to discuss any of today's general topics in more detail, please reach out to your Fairport advisor. Thank you for listening, and look for the next Fairport Flash in about a month.